Lululemon shares plunging as earnings guidance last night comes in well below estimates. The company saying the impact of tariffs and the removal of the de minimis in particular exception are hitting sales. CEO Calvin McDonald joins us for an exclusive interview. Calvin, first of all, it's good of you to come on. I think the market really wants to hear what you have to say. Thank you.
No, thanks for the time.
So the guidance cut, second time this year. What happened?
Yeah. Obviously, as we've evolved through this year and the tariff rates have been solidified, we've been able to update our guidance as a result of that as well. De minimis through the executive order and executed at the end of August was something that is new and we had not anticipated. We had planned for it in 27 with the great, beautiful bill, but the expedition of that earlier resulted in the guidance updates that we provided.
So de minimis obviously was a much bigger deal than you thought and that the street was expecting. Why does it hit you harder than your competitors?
Yeah, with a DC network in Canada, it was a program that we were able to take advantage of. About 2/3 of our online orders were shipped from our Canadian facility. A majority of those orders are under the $800, so we do move from paying no tariff to paying tariff on those goods. So we are in the work of shifting and changing our distribution network as a result and acting into it, but it will take some time to make those adjustments.
So you are changing because of what's happening here, changing the whole process?
We are, as a result of tariffs, I think it's a paradigm change for the industry, and we've mentioned the three levers we're looking to: vendor partnerships in terms of cost reductions, our own cost reduction, as well as pricing, and looking at elasticity. And looking at our network is definitely something that the team has been in that work.
Are you raising prices on apparel because of tariffs?
There will be some increases. We've taken some through our elasticity modeling. We're introducing a lot of newness and innovation through the rest of this year, but in particular into next year, that gives us an opportunity to price accordingly. So we will continue to monitor. It's not across the board. It's very strategic in where we've seen opportunity to price, but we have taken some pricing as a result.
Because we were just having a conversation about whether the uncertainty about tariffs, what the rate will be, whether they'll stick, whether they're legal, is having an impact in the executive suite. Are you doing things differently, or is that uncertainty manifesting in some way?
We're definitely moving forward with what we know today as being certain. And I think if there is opportunity to have those reduced, then some of our actions we may not need to take that we're planning. But because we're not fully and we're taking time to plan into it, we have a great balance sheet, cash position, best-in-class margin structure within the industry. So we're going to make sure to make the right decisions to protect the brand and the momentum.
Okay, but this is not just a tariff story. Clearly, what's weighing on the stock and what's weighing on your performance, the growth has come to a halt in the key market of North America. What's going on? Yeah,
as we shared, our international growth momentum continues, and we're not happy with our performance, particularly in the U.S. And when we look at that, it's really rooted in product, in particular in our lounge and social categories, linked to some of our successful core franchises that we need to update and bring newness into to delight our guest. And we've not done that over the last
You just had the
period of time.
wrong assortment, wrong color, wrong style. What was it?
The newness. The guest has responded incredibly well to. What I would say is we haven't brought enough within those categories to engage the guest to have her and him, spend. Our new guest in the U.S. is positive. Our guest spend with our low to mid value guests, so those that are younger with the brand, is up year over year. Our high value guests are over indexing on our new styles, so they're engaged. Their retention is up year over year. It's frequency linked to spend on the core franchises that they have, and they're waiting and reacting to new. And what we need to do is bring, through innovation, more newness to that guest in particular. And I would say our mix right now doesn't represent what the guest is reacting to. And that's the work the team has been in and will continue to improve 26 and through the year.
I wonder how much of it is just the fierce competition. Alo Yoga, Viore, I mean, these brands are really hot right now. Are they taking share? Has that been part of the story?
We've gained share in the premium activewear in Q2. The consumer spending less in apparel, less in activewear, and less in the premium activewear. That said, we know we can do better, but we are growing share. There's a lot of share for us to still gain and grow. When I look at competition, we know when we deliver, we win. We've delivered innovation in our performance apparel. We've grown that. We grew that in Q2, and we grew market share in that. Where we lost the opportunity is in the lounge and social. We became predictable. Our guests weren't reacting, and that's the opportunity. We disappointed them, we're focused on. But with competition, we have a brand that is uniquely positioned, a guest that's incredibly loyal. We just know what we need to do and do it better, in particular in a couple of key categories.
How long does that take?
We hired Jonathan Chung as our lead creative director a year ago. He and the team have been in that work. They're incredibly energized. They're energizing our product playbook. There's a lot of excitement in the organization around what's coming. And we know we need to show that to the guest and get them to react to it. But I would say that we're not at the starting line. We're well into the work and well into the race, and it progressively gets better. But next year is really the shift from a 23% on average of our mix of new styles to 35%.
So next year is where we should look for some sort of turnaround. I guess one question investors and analysts are wondering today is it going to get worse before it gets better with the numbers?
Yeah, we guided with our point of view on momentum, uncertainty with the guest for the back half of this year. We have not provided 26 guidance other than indicating the impact of tariff and de minimis into next year. That aside, we will provide guidance, but I am confident in the new styles that we're seeing. But clearly, we got to put them in front of the guest. But they are reacting to the new now, and there is exciting new coming
You're encouraged
into next year.
About that.